evening, everyone, and welcome to the Altos Trading Live Strategy Session, first one of 2023 with Jeff Tompkins. This is your host, Richard Van Rich, and we have with us Craig Ward in the chat. And we're glad really to have you with us here tonight. You got a lot of information to go over. New year, fresh start, a lot of great things. If it's your first time on, you'll notice your microphones are muted. That's so we can all hear Jeff and I talk. But there is a Q&A box and a chat box at the bottom of your screen. If you move your cursor, and you put questions in there throughout the evening, we'll answer those, and also before we hop off. If we do fall off or get bumped or you got to run away, don't worry. This is recorded and will be available in the members area later tonight. If you're watching us on YouTube, like and subscribe so you can get more of our videos as they come out. We're going to be doing a lot more videos this year. And again, last year we did almost 50 of these sessions, and we plan on doing just as many this year. So again, check us out. And if you have any questions about your account, access to Zillion or Trade Trend, or anything about open alert services, anything to your membership accounts, anything like that, email support@altostrading.com, and we'll get to those sometime tomorrow. We're focused tonight on teaching. Before I bring on Jeff, let me read the disclaimer to keep the lawyers happy. Altos Trading LLC and Trade Trend Zillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and various stocks and other securities. However, publishers of Altos Trading, Trade Trend Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Trend Zillion software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or an investment advisor before doing so. All right, with that being said, let me bring on Jeff. Jeff, if you're there, go ahead.
Happy New Year.
Happy New Year.
Happy New Year. Thanks, Kumar. Happy New Year to you. Happy New Year to everybody on tonight. Let's kick off the new year on the right foot. That's what we're here for, right? It was an ugly year last year.
It was.
Yeah. So welcome, everyone. 2023. Never thought I'd live to see this day. But I have. I made it.
That's right.
So, yeah,
go ahead.
Richard and Craig are getting pummeled by a thunderstorm. So hopefully we don't have any technical issues tonight.
Yeah.
You might hear some loud claps of thunder in the background.
That's right. It's like a monsoon over here. We're in Atlanta, and we went from having this freezing cold temperature to a bunch of rain. So hopefully it's got better for you up there in Boise.
Yeah, we've mellowed out here. It's been clear in 40s.
That's not good.
In the 40s, so it feels tropical.
Tropical heat wave.
Yeah, exactly. So, all right. Well, Richard and Craig will be moderating tonight, answering questions, relaying questions, and again, you can put those in the chat or the Q&A box. But want to welcome everybody as we kick off the new year, and we've got an exciting session tonight. Starting out with our key levels to keep an eye on. We've got quite a tight range forming on the major indices, and I suspect we'll break out of that here sometime in the near term, next week or certainly this month. I don't think we'll stay in it much longer, but the direction of the breakout, I think, is going to lend us a lot of clues to what might be expected for the rest of Q1. But also, we want to be mindful of potential false breakouts. So we'll really take a close look at some of these key levels and where the bottom and top of these ranges reside. So now that we've wrapped up December in 2022, we can go back and revisit the 36-month moving average on the major indices and analyze where we closed in relation to that and what it might mean for the markets as we move into the new year. Some really significant analysis I think we need to do around that to give us a more clear direction of market sentiment and potential directional moves. And that's going to tie into our topic for tonight, which is how to identify the confluence of static and dynamic support and resistance. So we'll talk a little bit about what each of those those things are, both static and dynamic support and resistance, why we should be using both of them together and looking for confluence. In other words, both of those factors lining up to give us a stronger indication of significant levels. And then we can use that information to forecast market moves, gauge market sentiment, identify the potential magnitude of a move past a static and or dynamic support resistance level. This is one of the key foundations of my trade, my trade plan, my methodology. I use this really virtually in every market and every strategy that I incorporate in my trading arsenal. So it's kind of the foundation of my methodology, and it's as far as statistical edge and the advantage it's given me in the markets. I can't emphasize enough like the difference it's made for me. So that's why I want to really focus on this and help you guys use not just static horizontal support and resistance levels, which is what most people use to identify areas of support and resistance or even trend lines, but also dynamic support and resistance. But more importantly, again, the confluence of those and lining them up and using them together, it can be a very powerful tool and edge in the markets, regardless of time frame, regardless of asset class. So that's going to be our topic tonight, because we've looked at both in the past, but we haven't really looked at them together. And we're going to also incorporate other price variables that, as far as like levels to watch, one being expected move, which we've also covered in the past, but that's something that we incorporate into this type of analysis, and it gives us a really great statistical advantage as far as planning out our trades and forming strategies around our expectations. And then, depending on how long that takes, tonight we will then continue on to our ticker roundtable. So we'll try to leave a little bit of time for that tonight, and then wrap up with Q&A. All right, so let's go ahead and hop over to our charts. Don't know why that switched on me. All right, so you refresh our dashboard, get today's current data, and we'll start out by looking at the S&P, which, as I mentioned, is in a very tight range with well-defined lower support and overhead resistance. Oops. I'm going to really zoom in here. Before I do, just looking at the overall structure, we have a very well-defined but quite dramatic, and what I mean by that is the legs of the trend, or the waves, are pretty pronounced and extreme. You look at the trend structure going back to start of last year, 2022. I'm gonna have to get used to saying last year. But you can see that we've got these very extreme directional legs within the trend. So just from kind of a high level perspective, and also something to point out here, we've had, let's see, probably at least two significant false trend reversal. So one of them is right here. So we broke the high of the previous pivot. And then same thing happened here. So this actually gives us, just real quick, and we will delve into this a little bit deeper. But when you see, again, looking high level, kind of zooming out from your chart, looking at these major legs or waves within a trend, and if you identify the major swing points or pivot points within the trend, being there, when you see a false trend breakout, in other words, we're in a downtrend, and then we rotate higher. So we're making a series of lower highs, lower lows. We rotate higher and then take out the previous pivot. So that's what happened here back in March of last year. And then rather than breaking this downtrend, which likely at some point around an area of support, which looks like right around the 4,400 level, you can see that as the S&P rotated lower, we kind of stalled and began to rotate off that previous downtrend pivot. This is where, with a high degree of reliability, when this occurs, and if you can identify it as a false trend reversal, very frequently results in a significant resumption of the actual, the previous trend. So in this case, a downtrend. So that would occurred right here as we trapped and faked out a lot of traders on the long side, and then came through and broke and made another leg lower to resume the previous downtrend. So that again happened here in August and September. So we take out this downtrend pivot from back late April, early June, and you can see it didn't quite happen right at that pivot, but if you had identified this area of support around 4,100, 4,150, you see right here we start to rotate higher, leading a lot of people to think, okay, this is the trend's now reversed because we put in a higher high on the pivot instead of a lower high. So we're pivoting higher now, and it traps everybody. And if you look at the candle that confirmed that, it's a very wide range bearish candle. So that was really the trap. And then of course you look at the resulting move, huge leg lower. So I've made this quite a messy chart, but I'll clear that out. So the downtrend is still intact. And these are really our major pivot levels on the S&P. In fact, it's a very well-defined trend line. And we're kind of in no man's land right now. This is kind of a box and I'm going to draw it as a box with the lower end of the box being support and the higher resistance, that we want to be very cognizant of and cautious about when we end up breaking out of it to the upside or the downside. But I wanted to point these major downtrend pivots out to you because as we draw this line, it ends up coinciding with a major millennial mark on the S&P, the 4,000 level. And we want to watch, if we do rotate higher, we want to extend this trend line as the markets play out and really watch that for dynamic resistance and be very cautious of a false breakout of this trend line. So 4,100, and this is obviously a ways away from current price levels, but 4,100 is major medium to longer term resistance. All right, so this is not something we're going to encounter this week or maybe next week or maybe not even in January, but more, again, medium to longer term, 4,100 is key because that's our major downtrend pivot level on the the broader downtrend that ensued as we shifted from secular bull to bear market conditions. And then 4,000 being our millennial mark is key as well. So if we get up into this zone between 4,000 and 4,100, that's a bit of a dangerous territory. So we could see a lot of chop, a lot of false breakouts, and again, particularly with this downtrending line, and then the horizontal 4,100 level is our bearish pivot level. Watch for a false breakout there. So again, not very, very unlikely, almost probably impossible to encounter before we meet again next Tuesday. But if we do break the range that I'll emphasize here in just a second to the upside and get into this zone, we'll be watching how price reacts in this 4,000 to 4,100 zone. But what we really need to see is a breakout, a retest, and then, so that would look something like this, like a breakout, a retest, and then a leg higher for confirmation of into this major downtrend. And that's really the methodology that can help us avoid what we see again here and here, where we get a false breakout of a major downtrend pivot, and a lot of traders get trapped. And there's a lot of ways that we can really effectively play that. We can wait for the trap to occur, and then if it follows through and the downtrend resumes, those are good opportunities to take short positions or bearish positions in the market. All right, so that's again more medium to longer term. But as it relates to this week, right, over the past a couple of weeks, we've been in, again, I call it no man's land. I mean, it's like we're ranging between two century marks, 3,800 and 3,900. And the market is just kind of waiting to see what's going to push it out of this range. So this is kind of our box that we're stuck in right now. That makes it very difficult to put on any type of directional trade right now, and maybe even like a non-directional trade, because there's a high potential for a false breakout to the upside or the downside. So how this is how I'm playing this right now. So I'm really sitting on the sidelines as far as trying to put on any short-term trades, because I want to wait and see this range box that I just drew in the yellow box is so significant and key for what we might expect to see in Q1 and beyond this year, that I want to be patient and wait for confirmation that we're going to break out one way or the other, upside or downside, with conviction and not false breakout. And so you can see a lot of these trading days here that we're just getting these wicks down into or near, and there was a false breakout last month to the downside, these levels. So what I do with that is, I want to see, number one, a close below. So these are static support and resistance levels, meaning they don't change as it relates to historical price. They change. The levels might become more relevant in the future, or other levels might be, but they're static. They remain the same, and we're identifying them by using past price action around the levels, right? So if we see multiple touch points and reversals, or looking at like closing prices on the candles around these levels, or lower or upper wicks around these levels, we're looking for touch points. How often is it touched? How far back is it encountered these levels? So how frequently? What was the magnitude of the move off the level? Was price ranging within the levels like we're currently looking at on the S&P? Those are all factors that we're incorporating into the static horizontal support and resistance. So great practice. It's when I was starting to learn and incorporate these into my trading arsenal, I would just pull up random charts and just do this one after the other, and until it just became second nature, and you can spot them. And then the nice thing is, with a static horizontal support and resistance level, is they remain static, so you can extend them out into the future and use them to forecast where price might reverse or stall or break through, retest, and then resume that directional move, all of those things. And so they're tremendously valuable. It just takes practice to identify them and learn how to analyze them and use them as part of a trading strategy. So going back to our current range box that we're in, with resistance at 3,900, which is another thing to look for as it relates to confluence and static and dynamic support and resistance, are what we call century marks, right? So these are probably more psychological factors than anything else. But when you start to map these out, it's interesting that you see like all this price action, trend reversals, false breakouts, all these things that often occur at major big round numbers. They're century marks, 3,900, 3,800, or a half century mark like 3,750. On the S&P, we go down to quarter century marks. So generally, unless you're like trading very short intraday timeframes, most of the stuff you see, like on a 1 or 2 minute chart, in these small price intervals, is a lot of chop and stuff. So it's not, we're really using these in the context of longer time frame charts, like a daily chart. Intraday charts still relevant. I mean, an hourly chart, a 4-hour chart, yeah, it can be relevant, but certainly like daily, weekly, monthly charts, these are critical to know where these levels reside and what price is doing around them. So century marks are a big deal on the S&P, and that's why you often see major reversals, retracements, breakouts from these types of levels. So like 4,100, that's a century mark, right? So way back here in September, early September last year, we can be aware of 4,100, right? We saw we've seen support and resistance, right? So when December rolls around and we have this big run up in Q4 of 2022, we could have been very aware of 4,100 based on past static resistance. Right. So again, just not to beat a dead horse, but it extend these forward, right? Once you identify them, they continue to be relevant indefinitely. They can go on for months and years. So going back to our box range that we're in now. All right, so roughly 3,900 to 3,800. We're eventually going to break out of this, right? So how do we avoid a false breakout? So this could happen this week, or maybe next week. I would be surprised if it extends past next week. But how do we avoid a false breakout? Well, past price is giving us clues. So, here was a close outside of the 3,800, 3,900 box, but we gap up the next day and we're back in it, right? So we need to avoid these kinds of like false breakouts. But now we have some reference points, some actual price, historical price levels that we can use from past false breakouts, particularly this one I just identified and this one on the downside. The upside has remained a little more solid, which, not to get too into kind of psychology, but that when we see false breakouts to the downside but not the upside, it tends to give us a little bit more of a bullish weighting, because we're not getting bearish false upside breakouts, we're getting bullish false downside breakouts. But we don't want to put too much into that, but it's good to know. But we do have a couple, maybe even three, if we look at today. What was our low? Yeah, so we did breach 3,800 today. So we've actually got a number of false downside breakouts of this box range. So what I want to do is, and we'll incorporate dynamic support and resistance into this as well. But what I look for is the lowest low for a downside breakout of a range or a support level, since that range was established, right? So that was on December 22nd with a low at 37.64. So if we start to see price break 37.64 on the S&P, and particularly if we see price close below 37.64, we could be down at 3,600 in a week or two. It's going to open the door to potential retests of last year's October lows. Okay, so that's what we need to watch out for near term. Okay, and this will have a market-wide impact, right? It'll drag everything down, just like kind of today, like Apple and Tesla just drag the market down. Apple is now broke below their I think $2 trillion market cap today. So, and then Tesla lost, I don't know, 12% or something today. So that those two stocks alone dragged the markets down, right? So that's all it really takes to do. But we're still finding support around 3,800. So this is, again, going to be difficult to navigate until we get more clear direction. And so that's what it would be to the downside. I'm looking for S&P to trade below December 22nd's low. And in particular, if I see closes below that day's low, then my bearish case scenario is going to be much increased. And then I'm looking for retests of like 3,600 and potentially even mid-October lows, which was the lowest low for last year for 2022. And then we do have a support around another century mark 3,700. So if we do break this, that's really this 3,700, maybe 3,750 is going to be our next lowest level of support. Now, what happens if we break to the upside? Well, it's a little less promising if we get out of the box on the upside, because we've got really strong resistance not far outside of the box. So we've got a lot more distance between the lower range of the box and the next level of support than we do the upper end of the box and the next layer of resistance. So again, we're just looking at touch points here, and I could have extended this much further back, but there's a lot of other prior support and resistance right around 39.20 or so, right? But you can see this here that I want to point out, because if we do break it, be very careful of false breakout. False breakouts tend to occur when you break out of a support or resistance level with another support or resistance level in very close proximity. So this is high risk of false breakout to the upside. So those are all the things to be thinking about as we're still playing around in this box, right? So for me, the more prudent thing is wait for 39.20 to break, retest, and then I've got more room to move up, right? Still want to keep a close eye on 4,000, right? And then as it relates to more medium to longer term, if we are, if we do end up breaking out to the upside, then I'm really watching the downtrend pivots, which again are right at about 4,100, another century mark, right? So again, not going to happen before we meet again, but whichever way we go, we'll continue on with this analysis. So I spent a bit more time on that with the S&P than we typically do, but those are really significant key levels. And then we'll take a quick look at the Qs and the VIX, which will really help us in terms of analyzing directional movement to the upside or downside as we're playing around with these critical levels. Now, on the Qs, the NASDAQ 100 ETF, we've got very strong support, right? So really have like kind of a triple bottom here. We'll draw this as we talk about particularly static horizontal support and resistance. Often we can look at it as a zone versus only one single level. So when do I make it a zone versus a single level? Well, right around 260, we've got very obvious support and market rotation, right? So we're trading down into the level and then bouncing off, right? So that's easy to identify. But we've also got a key low, because this was our low mid-October from 2022. So I want to make this a zone and not just ignore that low, because if we retest lows, then this level will become very significant, and that will make this a support zone and not just a single support level at 260. So this is but with that being said, 260 is critical to watch for NASDAQ 100, right? So we had a really nice sell signal here that today would have been stopped out at the trailing stop level. But we did gap up, close lower, and by all appearances, looks like we might retest this support. So the key with the NASDAQ right now, again, today really dragged down by Apple and Tesla. Not really, any other real identifiable catalyst for today on the NASDAQ. We want to watch this 260 level on the Qs. If we can rotate higher off, then it brings in another factor that is key to analyzing support and resistance, and that's in terms of the strength of the level, is how many times, not just was the level touched or the markets trade around the level, but how many times did it actually hold? So if we're using it as a support level, is the case of 260 on the Qs, did price hold that level and move higher? Or what are the other possibilities? Was it a breakout? Was it a false breakout? Was it a period of ranging price action around the level? So historically, we've seen strong rotations off this level. Now, since past price action doesn't indicate future price action, we don't know that it's going to do that for sure. We just use it as an edge based on a lot of buying activity coming in historically at that level. So this support zone will be critical for the tech sector, the NASDAQ 100, and the broader markets, and could put us into a more medium to longer term range, right? Which also is really a resistance zone. So it's a bit wider, but these are our key NASDAQ 100 levels to be watching near to medium term. So still kind of stuck in a range, but oftentimes, these ranges can signify a bottom. I'm not calling a market bottom. There's a lot of things that could happen. We could, continue to trade lower, and we're going to look at the monthly dynamic support and resistance on the S&P and the NASDAQ. But oftentimes when we have such a significant market sell-off, particularly over the course of a year like we did last year, then when we start to see medium to longer term ranging, it can be foretelling of a potential reversal, but too soon to tell, just FYI. Okay, so let's look at the VIX real quickly. So now the VIX gives us a lot of good information, lots of good information, but it can also be a bit tricky when it gets choppy, which it's doing right now, right? We're kind of in no man's land on the VIX. Close today, 2290. We're really watching 20, right? So again, the way we use the levels on the VIX relative to the indices is we look for major support levels on the VIX to break to the downside as the S&P and the other major indices break resistance to the upside. And that gives us an enormous edge in forecasting a directional movement. Okay. So I'm just going to quickly draw these levels because, again, we're in a bit kind of a no man's land. So this support range, and again, we're just looking at static support here, resides at 19 to 20. And our resistance range resides around 24 to 25. So what we want to consider is where are we on the VIX relative to support and resistance? Are we closer to support? Are we closer to resistance? We're closer to resistance, right? So when we're near support and resistance levels, that's when we want to expect potential, more significant potential reversals or breakouts in the market. So when we see VIX near resistance, if that resistance holds and we rotate lower, and due to the inverse correlation of the VIX and the S&P, with VIX rising when S&P falls, if we see VIX rotate lower off resistance and S&P break out of resistance, that gives us an edge over just using the S&P chart, right? Because it's telling us volatility is contracting, it's coming down, and the VIX tends to fall when the market, right, the S&P rises. So that's what we want to look for here, is for the 24 to 25 resistance zone to continue to hold as support. But again, where this becomes difficult is we're getting chopped around in this box here. So we're getting a lot of, VIX readings between 20 and 24, 25, and we've got the S&P sandwiched between 3,800 and 3,900. But to be prepared for the breakout in either direction, we want to use the VIX in correlation with the S&P, right? So as long as we see the VIX continue to bounce between this support and resistance range, and we see that also occur on the S&P, for me, I'm just sitting it out. I'm going to wait until the VIX and the S&P tell me which way they want to go, which they're not doing right now. All they're telling me is they're in a range and they haven't decided, right, which way they're going to go. All right, so now let's look at something that was not what I wanted to see, but nevertheless occurred. So number one, so we're looking at a monthly chart now of the S&P. We closed out 2022 in technical bear market territory. So from our peak in January last year, 48,1862 on the S&P, to trough, which was back in October, we were well in bear market territory. But as it relates to the close of last month, December, this is our monthly candle from December, which was at 3839.50, we closed in bear market territory. And we talked about that last week, right? Now, as we look at dynamic support and resistance, so what is dynamic support and resistance? Well, it changes as price changes. So if you use, the most obvious example would be a moving average, right? If you're using a moving average as support or resistance, due to the formula of the average, and then it's taking an average of historical pricing, it is going to change as price changes. So that's the difference between static and dynamic support and resistance. So these levels here, this is our bear market level that I just drew the arrow on, is a static level. It's going to remain until the high, the all-time high in the S&P from last January is broken to the upside. This is going to remain a static bear market level. It's not going to change until this changes. Right, so this is a static horizontal level. I know exactly where the bear market level is, and we closed below it last month. We also closed below the 36-month moving average. So it's pretty incredible that that moving average is almost, see exactly what the number was, almost right at the bear market level. 3857.79 was our moving average reading for the 36 period, 36 month, looking at the monthly chart moving average from December, right? And our close was at 38.39. So, but the actual moving average level was almost right at the 20% peak to trough bear market. level. So this is where the confluence come in. Also notice something. And I don't even ask myself anymore. Like, I would drive myself crazy if I just am, pondering how in the hell do like these levels match up so perfectly all the time? Like, it almost blows me away. And then you start to wonder, like, do people know this? Is it like some mathematical anomaly? Like, how is this? Is it just, kind of a serendipitous thing? Like, this is the result of all this, knowledge and all the variables and factors that people are making trading and investing decisions on, and they're just lining up, coincidentally. Again, drive yourself crazy trying to figure that out. But this is what I'm talking about with confluence. So this horizontal bear market level, hopefully you guys can see that okay, but nearly perfectly lines up with our dynamic support and resistance. In this case, it was support. I'll explain that right there. So when it comes to dynamic support and resistance, how do you know if it's support or resistance if it's just one line? If you're coming in from the upside, so like if you're rotating lower into dynamic support resistance, it's dynamic support. If you're coming in from the downside up into the dynamic level, it's resistance. So as it relates to December, we were trading above the 36-month moving average. So as we rotate lower into the average, it's support. So then why is that important, and how do we use that information? Well, if we break support, whether it's static or dynamic, or both in this case, because we have confluence between both static and dynamic support. This was also support because we rotated lower into this horizontal level, our bear market line. Then it's it was prior support and it's broken. And what happens when support is broken? It becomes resistance. So what are we going to see? We've actually already seen it. What are we going to see in January? So that was like a historical analysis, but how do I use that for future analysis? Well, if support is broken, both static and dynamic, let me clear these out here, then it becomes resistance. And if you look what's already happened this month, what did we do? We came up, and again, this going back into the daily chart on the S&P, this is the top of our range box, right? 3,900 century mark. We've come up and it's found resistance there. And if I zoom in even more, look at the confluence between this 3,900. I'll point out some other examples too. Resistance, support, right? False break of support. We find resistance there. So now I'm using this as a forecasting tool, and I've already done my historical analysis. I found confluence between static or horizontal support resistance and dynamic. So there are a lot of things we can use, a lot of tools we can use for static and dynamic support and resistance, more so on the dynamic side, right? So as we just looked at, we use 36-month moving average on the monthly chart for the major indices. And I think it was a couple of weeks ago, we looked at using shorter period moving averages to form and I don't remember or recall that we labeled it this way, but it's looking at the buy and sell zone between the two moving averages is also dynamic support and resistance. So when one average is below the other and they're both sloping down, and price trades up into it, which is resistance, that is obviously a static zone of resistance. So moving average is one. That's an obvious one. Another big one I use is volatility bands or Bollinger bands. There are other obviously examples of range bands like average true range bands and other indicators and tools. But the Bollinger bands are a fantastic, powerful tool as it relates to dynamic support and resistance, right? And so you'll often see those act as areas of dynamic support and resistance. So again, what I look for, if we just let's pull up Tesla, since kind of the hot stock of the day in a bad way. I look for confluence between static, which would be our horizontal level, support and resistance, and dynamic. So right now we're trailing, and this is part of our slingshot setup that we've covered a number of times in past weekly sessions. We're trailing dynamic support, right? So if you guys have ever attended any of my slingshot educational sessions, this is how we use these together. We look for the volatility breakout, in this case on Tesla to the downside, trailing lower 2 standard deviation dynamic support into a horizontal level of support, right? So once I've identified the dynamic support, I look for horizontal, and going back historically on the chart where price has encountered that level and reversed off of it, or any of the other number of combinations of possibilities we talked about. And it's typically at these confluence areas where they both line up that we can find very high probability, reliable trading opportunities, because we tend to see more follow through, stronger trend direction, stronger reversals with longer duration and greater magnitude than if we only use like one of them alone. So that's kind of like the base case for using the two together, both static and horizontal. We'll look at a couple more examples. But before we do, I want to throw in one other thing. So those are ways to really do this visually on a chart. The other thing that method I use incorporates options, and also another topic we've talked about in past weekly sessions, and that's expected move, which I'm on the Thinkorswim platform. You can find on your options chain. So any optionable security, you can find the expected move at any future expiration date. So if I want to know, what is the option market pricing in for a move on the S&P 500 index by this Friday, so all I have to do is look over on my chain, and it gives me the expected move between now and Friday of 73, roughly 73 points to the upside or downside. So what I'll typically do, and this actually, you want to do this before the trading week starts. So after the Friday close, is a great time to go in and look out to the next week, because now the trading week's already open. So options and pricing has been moving around and affecting volatility and expected moves. So what I like to do is over the weekend sometime, or before the market opens on Monday and after it's closed the previous Friday, so you've got a couple days, is go into your options chain, and you can do this again for any optionable security, but I definitely do this on the major indices, the S&P, the NASDAQ, the Russell, and then if I'm going to trade a stock or set up an option strategy on a specific security, then I'll do that on it as well. But before the week starts out, you can go out 1 week. So, let's say you sit down over the weekend, open up your options chain, look at the S&P 500 chain, and you go out to the next Friday's expiration. So when you identify the Friday expiration, you go over and you look at the expected move. It'll on the Thinkorswim platform have plus or minus, and then the number of points. And you can go ahead and, outside of the visual identification we just did on the charts, you can add and subtract that from Friday's closing price and draw your static horizontal levels there. So plus whatever the number is for Friday's expiration to the upside is your resistance, and minus that number based on Friday's close to the downside is your support. Those levels, while they're absolutely broken periodically, historically are highly accurate in identifying the next week's range. So another really important exercise to do on the indices. And you can do it midweek, but I prefer to know where those levels reside before the trading week starts out, and then I just keep the levels on my chart so I know where they are. And then I can monitor, how things change as implied volatility and expected moves change throughout the trading week. And that can also give me a lot of insight and clues into bullish or bearish sentiment. So I'm, looking at all that as it plays out, again, tying more into the dynamic support and resistance of the markets. After I've drawn my static support and resistance based on expected move on Friday, the previous Friday's close, for the week. So another really great, tool to add to your toolbox as far as kind of knowing what to expect for the week. Because if we break expected move to the upside or downside, those tend to be, weeks where we if it happens earlier in the week, we might see a continuation of that move to the upside or downside for the remainder of the week, right? So if it happens like on a Monday or Tuesday or maybe even Wednesday, I might be ready to jump on and take a position in the direction of the expected move breakout, right? Especially if it lines up. And again, this is related to confluence, especially if this expected move level lines up with one of the static horizontal or dynamic support and resistance levels that we've identified. So again, just another really good tool to add into the confluence of these static and dynamic support and resistance areas. So real quick, and then we'll open it up. If you don't, most options, brokers are going to have expected move. Some of these formulas are actually proprietary to the broker, but there are a couple ways you can actually calculate this on your own. If your broker or your options chain doesn't provide the expected move, like Thinkorswim here, we just go out to January 6th, so this Friday's expiration. A really quick and dirty way to do it. It's again not going to match up exactly because this is a more of a formula-based number provided by Thinkorswim. You can just add the at the money straddle. So SPX closed today 38.24. So we'll just round up to 38.25. So you would just add the at the money straddle. So that's basically buying a put and buying a call at that strike. You can just do it. Let's see, buy a straddle. Okay, so if I were to buy a 38.25 call and a 38.25 put, add up the premium, it's 74.05. It's pretty close to 73.26. So that's kind of a quick and dirty way to get your expected move from if you just use the options chain. All right, so just round the closing price to the nearest whole number or strike price you can find on that in the options chain, and just calculate the cost of buying a straddle at that strike price, which is basically buying a call and buying a put at the same expiration and same strike price. Okay, so I went a long time today, actually, geez, almost an hour, without really pausing, but wanted to really emphasize number one, how to identify both static and dynamic support and resistance. Some of the tools we use, like Bollinger Bands, moving averages, many of which we've covered in past sessions, where you can find more details from our recorded training sessions. And then lining those up with our static horizontal support and resistance, looking for the confluence, like we looked at on the current monthly chart of S&P with the 36 period moving average, and then also using expected move and looking for these levels to really line up, because the more they line up and the more price action and significant reversals and directional moves off these levels, the stronger they are, and they're very valuable for forecasting future anticipated price action, because they often hold and or I should say they often remain relevant long into the future. All right, so sorry again for kind of going into a long-winded explanation of all that, but hopefully it was valuable to you guys, and I'll open it up to questions, and we can look at any tickers and all of that stuff.
Let's see. SP had an interesting question. When there's a buy signal, if you see it come up on a red candle, do you feel like that's less reliable, or does it matter to you?
No, I wouldn't say it's less reliable. What would be more significant is what we've covered tonight. Is it a buy signal into a resistance level? Then, and I see one right off the bat here on Tesla, then I don't like it, right? So if you look at this horizontal, which actually more confluence, although at the time it was in the future, but ended up a couple weeks later being dynamic resistance. But if you look at this buy signal here, right, it was right into a very strong level of resistance. It's all over the place, right? And here it really helps to really zoom out of the chart. You know, like if on a daily chart, I look back a year or even 2 years, sometimes more, but at least a year, and look for these levels. So this was one into, it was actually a buy signal on a bullish candle. And in the absence of that resistance, it would have looked great, because it was also off support, but it was right into resistance. So I don't have room to run if that resistance level holds. Now, the sell signal I liked. It was into support, but I can use this support level once I've identified and mapped it out. This is, again, a static horizontal support level and dynamic support. And what I would look for in this sell signal here, which forecasted this move nicely off resistance, is I look for the volatility expansion, again, what we call the slingshot, price to trail, the lower volatility band, and break the support level. So this this sell signal right here, back from early November, was actually on a green candle. So yeah, the candle color is not relevant. It's really the static and dynamic support and resistance. We don't want to take a sell signal into resistance, into support, unless we plan accordingly to wait for that support level to break. And that was identifiable here with our volatility expansion, getting covered in past weekly sessions, diverging outer volatility bands and price trailing the lower band, and closing below our static level of horizontal support. So that's really those are the key things to watch, versus the candle color.
When you were talking about the expected ranges earlier, Michael's wondering if are the expected ranges cumulative? I'm looking at SPX, the numbers increase with time.
Oh, so I'm assuming he means like the further you go out, the larger they get.
That's what I assumed.
Yeah, because
Correct. He said correct.
right, yeah, they're not cumulative in the sense like you add them and they're going to equal, perfectly equal the next. So like if you added 39 to 54, right, it's going to be greater than. So again, we're adding these two expirations to this one. It's going to be, greater than that number. But they're larger the further you go out because there's more time for the markets to make a move, right? So you're always going to see almost always, I shouldn't say always, but almost always you're going to see the expected move. Something that might throw that as like an upcoming earnings on an individual stock or something, where you get you could have a potential like binary event that results in a very large positive or negative move in the stock near term, but then that volatility subsides after the earnings release and the expected moves drop. But generally, you're going to see expected moves increase incrementally as time goes on. And that's actually probably a topic for another day, but also a great way to analyze and get a really good feel for, the asset that you're looking at is what are the expected moves as they relate across time frames. That's an important thing. Like maybe you don't know an earnings release is coming up, but you're like, whoa, that's weird. The expected move like 3 days from now is greater than the one next week. Like what's going on? That could tip you off to something that might be happening. It might not even be a known event like an earnings release. Like it could be like let's say it's like a biotech stock, and there's like a PDUFA date coming up, which is basically like related to the FDA approval of a investigational drug like that might be in development. It's something you may not really be well aware of, but the market makers and the company executives and all of the people that are driving the share price of the stock are aware of it, and that can show up in the expected move. So if you start to, it can kind of help you paint a picture of what expected moves are as it relates to time horizons, and that's also something I use frequently in my analysis. So it's a good question.
All right, let's see a couple ticker requests. Could you look at CWH? That's Camping World.
Take a look at a couple here. So what we try to do, if you guys are new on with us tonight, when we do our ticker roundtable, we want to use some of the the methodology for the topic in that particular night on the stocks that we're analyzing ticker roundtable. So we're looking at a daily chart of Camping World, CWH, and so this is actually a great example of dynamic support and resistance. So again, using the Bollinger Bands, when we're at the lower band, that's our dynamic support. And it's again dynamic because, as you can see, again, this is our slingshot setup. Price can trail and the level moves with price. But when we look at static support, that generally remains constant, hence static support. And so interestingly here, we've had a retest of June, July lows, bit of a double bottom here. So we've traded along the lower dynamic support of the 2 standard deviation band into a support level. And this is exactly how I use the slingshot method, as I look for price to trail a lower band into a static support level. That's where I'm using both static and dynamic support, or an upper band into a resistance level. And there were some examples here from the past. So this one, let me just zoom in so this is easier to see. Has encountered both static and dynamic support. Looks like kind of right around 2050 or so. Again, more of a zone, 2050 to 21. And rotated higher. There was a buy signal, but it didn't trigger within the next 3 candles, so that there's not currently an open signal on this one. This one did not trigger. These sell signals were nice because they were into dynamic support in our slingshot setup, with some distance to some decent distance to lower levels of static support. But what's occurred here, and here's more confluence, so what we want to look for. So our center band is our mean or our average, right? There's a century mark. So as I kind of talk through this, these are all the things I'm looking for, right? Big round number, we got our century mark at 23. We've got our center band, our average. We've got our static level of support resistance, right? I'm looking back here. Where has price reacted around this level in the past? I could probably go way further back and still find price action around this level. So what we've done here is we found a very nice level of static and dynamic support on Camping World, but it's really already played out. We're now in the resistance. So now, where does our risk reside, right? So here, right, there was our opportunity to the long side. Now we're at resistance. So how do I play these types of situations? Well, I want to wait for a close above resistance, both static and dynamic. I want to close above 23. I want to close above my center band, my moving average. And to be more conservative, I want to then wait for a retest and a move higher. Then where am I going to counter static resistance? Probably around 24, a little above. Right now, my dynamic resistance is closer to like 25.75. But I've got some room to run to the long side if we can break through both static and dynamic resistance. So currently, I'm watching this key 23 level, which again contains confluence between static and dynamic resistance. So not just the outer bands, but our center band and the horizontal 23 level. And if it rotates lower, I'm expecting to move back into static and dynamic support. Look at that. Our band is coming right up. This is our dynamic support. It's coming right up into our static support, right? So I'm watching for move lower unless we break resistance, right? So that's how we use the two together. Great example. I know we ran over tonight, and but let's take another one and see if we can maybe find another good example.
All right, Overstock, OSTK.
All right, let me zoom back in here because we actually broke. So that Overstock was in, a pretty tight range since mid last year. In this one's a little trickier, but if you can see, it's like right at 23. And see how this support level is coinciding with the lower band, right? And then when we break support, it becomes resistance, right? And look how we came up, and this one was brief, over 2 days, found resistance back at that 23 level. And then when we break it, then becomes what? Support. It was resistance that transitioned to support. What happened? Well, here's a great example of static and dynamic confluence of support and resistance. Right at 27. Look at that. I mean, picture perfect. But then what happened? We came back down. It broke resistance, transition to support. What did the price do? It rotated higher back into resistance. So although we're doing this with the benefit of hindsight, believe me, this can be done with the benefit of foresight. You can do this if you understand how to use, find the confluence between static and dynamic support and resistance. This can be used in a forward-looking manner. So now we've broken support. Okay, so we're now down around, we've now trailed lower dynamic support. So we need to go further back and look for static horizontal support. And if we rotate, it looks like, I'll zoom out of the chart here real quick. It looks like maybe if I haven't even looked at the, past last March, April, but we may find, because what's price doing, it's basing around 18, we may find some horizontal static support there. And if that holds and then rotates higher, I'm looking for price to come back up into static and dynamic resistance. Look at this. Right around 21. There's our horizontal support. There's our dynamic resistance, confluence. So if we do rotate higher, what should I expect? I should expect, at least briefly, we don't, again, this is a fluid situation. We don't know, we don't want to just make an analysis and then call it good and say that's going to be it. Obviously, the markets are going to be open another day. So things are always developing. But if I were to take a long position off support, I expect to encounter some degree of resistance around 21, or my static and dynamic confluence of resistance, center band, horizontal level. And so if we do rotate higher, maybe it's only intraday and we hit that, or maybe we hit it and then rotate lower, in which case I look for bearish opportunities into support. Let's see if we zoom out, if we can identify any static support going further back. Sometimes you have to go way back on these. So let's see, 18. Not seeing any. I may need to go further back. I mean, now we're back into late 2018, and I may need to zoom in a bit more, but not seeing, maybe a little bit there, a little bit there. Real strong, significant horizontal level, but this is where also we want to really use zones versus just one specific level, like I mentioned before. So again, you can go further back. So even going back into 2018, some of these levels you can find from many, many years back. So now I'm starting to see it. So look back in 2017. Okay, there's resistance right around that 18 level, both support and resistance, if I were to zoom in a bit more on that. So I found some, it's way back, and I do have some fairly close proximity price resistance to the upside, but those are things I want to be aware of. And then if we break through resistance, those can be other opportunities, for long trades. If we can break through both static and dynamic resistance and it then becomes support, we can look for, maybe some better opportunities if we can get through this 21 level to the upside for moves up into, higher resistance, where I see around like the 2550 to 26 level, some confluence between static and dynamic resistance. That gives me a lot more room to run to the upside between 21 to 25, 26. than current price level up until like 21, especially with a rotation lower off of a resistance level. So another good example, but you can really find these this confluence between dynamic support and resistance all over the place. It's great exercise. Practice it. Again, look for the confluence for those levels to line up. If you feel like, you're imagining it, or you just can't, if it's not real obvious, then it probably isn't. You'll know it when you see it. You want it to be obvious. You want to see very obvious levels. If you're having to really like force it, then it's probably not a very strong level. So I hope you guys got a lot out of that. Again, it's work. I get it, and it's not like the magic easy, simple buy here, sell here thing. It takes some work, but believe me, like when I really started finding confluence between static dynamic support and resistance, expected moves, and waiting and being patient for opportunities where these things lined up, it made a dramatic difference in my results. And not just for entries, but once you get into a trade, it's tremendously valuable for helping plan the trade management component of the strategy, how you're going to manage it, where you're going to exit, or define your risk, put your stop loss level, or whatever way you're defining your risk, and maybe scale out of trades, or scale into trades or out of trades, all those things that goes into that decision making. So yeah. All right. Well, any final questions tonight, guys? And next week we're going to start getting into some actual more systematic strategies using a lot of what we've covered in previous weeks. So I'm really excited to reconvene next Tuesday, same time, same place. But any final questions for tonight, Richard?
No, I think we're good. Most people got a lot of the questions answered, a lot of comments.
Okay.
So I think we really enjoyed the conversation.
Oh, great. Well, I'm glad you guys enjoyed. Again, Happy New Year. Thanks to Craig and Richard for moderating and helping answer the questions. If you guys have any other lingering questions or anything you forgot to bring up tonight, you can email us support@altostrading.com. But I wish you guys a great rest of the trading week. Watch that box range on the S&P very closely for the rest of this week. And if we don't get out of it, continue to keep an eye on it. And we'll see you guys next Tuesday. Have a great rest of the week.